back. Well, I'm sure you've noticed how difficult it is to get through the month at the moment. Inflation figures, the price of food, all going up dramatically. A lot of this is to do with fuel prices. It now seems the inflation rate in many countries is much higher than it was in 2020. So it's affecting you, but it's affecting pretty much everyone. A lot of this is because of the pandemic, the way the pandemic has ended, the continued lockdowns in China, and then Russia's invasion of Ukraine. Lullu Krugel is the chief economist at PwC. Isaah Mhlanga is the chief economist at Alexforbes. Good afternoon to you both, and thank you for your time. Lullu, let me start with you. We know the impact that high inflation is having on us. What's happening with inflation around the world at the moment?
Well, to be quite honest, inflation is a massive problem globally, and in countries where we would not have expected inflation rates higher than what we're seeing in South Africa, we are in fact seeing them. If you're thinking about the US, for example, the UK, its inflation rates that's currently around 200 basis points above what we are seeing in South Africa. So it is not a contained problem. And in fact, it is currently, if you look at some of the more developed economies around the globe, Turkey has the highest rate of inflation in the region of the mid-50s, I think 45% or 54% or thereabouts. So a general problem everywhere. There are a few countries that is the exception, but the rule is that we're seeing very high levels of inflation everywhere.
Isaah, so is the same thing that's driving inflation everywhere driving it here? I realize, except Lulu's point, it's not nearly as high as it is in other countries, but is it the same forces driving this inflation?
Look, I think there are common factors. Food price inflation is global, it's not just local. Oil prices are global, not just local, but also energy costs tend to be generalized. In SA, we add our own dynamics with load shedding and electricity tariffs, but if you look globally, energy is a common driver of inflation. And the issue now here is we're starting to see the three components that are global starting to be generalized within the other inflation components. So essentially what the SARB would say pass-through effects is now starting to spread more generally, being visible in core inflation, which is more of a concern for central banks. And we are seeing it in the US, we are seeing it across Europe, and we're seeing it in emerging markets as we are seeing it in SA, which is why the interest rate cycle is going to continue to remain on an upward basis. And as of yesterday, might have heard that the central bank governor, Lesetja Kanyako, spoke of a potential 50 basis point increase in interest rates at the July meeting. That just affirms that they are also seeing the pass-through effects becoming generalized and they are concerned about it.
Lulu, I realize every country has their own sort of inflation dynamics and their own economic issues. I mean, Turkey, they've been trying to lower interest rates rather than raise them to cut inflation. That's what economists describe as unorthodox. But for years, I mean, as long as I can remember, Britain and the US have had lower inflation rates than us. Why now do we have lower inflation than they do?
Well, I think my concern is that we will probably see the impact.
Oh dear, that is probably load shedding making itself felt at this stage, unfortunately. Isaah Mhlanga, I think you're still with us. Let me put the question to you. Why is it that our inflation, for the moment at least, is lower than some countries which have had much lower inflation than us for many years?
Look, I think what we're seeing is not only the impact of the pandemic currently. We have seen unprecedented quantitative easing globally over the last decade. Come COVID-19, we saw significant cash transfers in the US, a decent fiscal stimulus in Europe, and that has been much of the reason why we are seeing inflation pick up across the world. And then the disruptions in terms of logistics, but also the disruptions in terms of the chips for the manufacturing sector, particularly the electronic sector, that have meant that there is reduced supply in terms of some of the components that would contribute into manufacturing pricing. That has also played a part. In particular, if you look at the US and the UK, the cash transfers that have been implemented during the pandemic led to an accumulation of savings by households, to such an extent that some households in the US have been opting not to go to work because they have been getting more money from the government than what they used to get in the workplace. When the economy started to open up as the impact of the pandemic eased, those savings were spent in an economy that had a short supply of goods. That has driven inflation up. In SA, 350 rands grant to cater for those impacted by COVID is not nearly enough to actually drive demand. So we don't have much of a demand pull inflation in SA as we have in the US and in Europe. That's why we are seeing the differences in the inflation dynamics between these regions.
Lullu, I see you've conquered load shedding and you're back with us, although your camera may be a little bit sideways at the moment. I don't know if you are able to fix it, but I do want to ask, can we expect that our inflation is going to stay this low? I mean, you've got the Reserve Bank governor, as I made the point, saying that, look, you can look forward to possibly a 50 basis points increase soon. Do you think the Reserve Bank is going to be able to keep a tight enough rein on inflation?
Yeah, the challenge that we are sitting with at the moment is the Reserve Bank is trying to control our inflation, particularly in terms of what could happen with our imported inflation through potentially the value of the rand. And as Isaah just so very eloquently explained, what we don't have is the increased demand that we've seen in other parts of the world, in particular before COVID. So the challenge that we are sitting with, whilst interest rates are quite effective as a measure when you have demand pull inflation in an economy, it is maybe less so when we're seeing what we are currently seeing in terms of cost push inflation. But we have to keep up with the movements in the rest of the world so that the inflation differential doesn't become too much and we see a significant weakening of the rand, which in turn can then again lead to increased imported inflation, specifically from fuel prices, etc. So, and it's also important in terms of managing inflation expectations. So we think people could think inflation could go. So if you see increased interest rates, and that is what the Reserve Bank have been trying to do for a very long time, being very transparent about what they do, because in that way they could potentially manage people's expectations about where inflation could go. And if you're able to do that, it might have an influence on things like wage increases being negotiated, etc., which in turn could also help the long-term inflation.
Isaah, we obviously look at two main things, I think, at the moment. Well, three main things, maybe. We look at what's happening in China. We look at what's happening in Ukraine, Russia's invasion there. That has a big impact on fuel prices. If both of those situations eased, let me put it like that, if somehow there was peace in Ukraine over the next few months, if somehow, and this is probably more likely, the lockdowns in China ended, that economy got back to what used to be called normal, what impact would that have?
Look, of course, that will be a positive outcome. It will be a confluence of good things, which are unlikely if you look at the current dynamics that are taking place in Ukraine. Russia is doubling down now, attacking sites that they did not attack previously. And the West, essentially Europe and the US, continuing to fund arms for Ukraine. So it's actually an escalation rather than a de-escalation. So that scenario is unlikely. But let's say it happened. It would mean that commodities markets are likely to get a reprieve. Oil prices are likely to moderate, which would imply that some of the inflation drivers, as far as the commodities market is concerned and oil prices are concerned, would ease and help South Africa. But I think the bigger issue that we have in SA is the debate between trying to help the economy to grow, in an environment where global economic growth is expected to moderate. At the same time, making sure that inflation keeps in check. And indeed, this is one of the big questions the SARB has to answer to. In stagflation, what does a central bank do? And essentially, stagflation is high inflation with low growth. Do you let inflation structurally increase in order to try and support growth, or you continue to try to control inflation irrespective of what happens to growth? And in our case, I think the SARB takes a view that they can't do much to stop the slowdown in economic growth. As a result, they will focus on their mandate, which is to control inflation, irrespective of what happens to growth, because in any case, they can't stop the slowdown in economic growth.
Lullu, there's so many different things to look at here and so many different factors. In the past, the world used to have much higher inflation than it does now. I mean, if you speak to people who bought homes, if they were able to in the 1980s, they'll tell you that that their interest rates were 25% then, unimaginable to someone my age. What changed? How was the world able to bring inflation down then? Are we able to do that again now?
So one of the things that have happened since is that a lot of the central banks introduced inflation targeting specifically. In South Africa, if I remember correctly, we introduced it in 2000, but in the late 90s and early 2000s, that was really the route that a lot of central banks have gone. And in some countries, they have specific targets, and we've been edging that way as well to say, should we try and keep inflation around 4 or 4.5%? But at the moment, that was pre the situation that we're seeing now. So that was one of the factors. And probably a big contributing factor is that everybody was had the same policy and did the same thing to do that. Combined with that also, if you look at it, you will also see that economic growth has slowed down significantly. Isaah mentioned what we as economists call the S word, or the very scary word, stagflation. It's an environment, as he explained, where you have low growth, high inflation, and that is really not where we want to be. So typically, where we did have inflationary or higher inflationary environments, it was often coupled with higher levels of growth. Having said that, if I remember some of the things that my parents have told me about the oil crisis in the 1970s, etc., oil prices and fuel prices also had a significant impact over the years on inflationary pressures, and that uncertainty and volatility also played a significant role. And we had a period now where we've seen oil price spikes, yes, but it was much more moderated and much more under control than what we were used to, maybe, let's say, in the early 80s and late 70s. So all of those factors contributed to the higher levels of inflation that we saw then, and the reasonably lower levels of inflation that we saw for a while now. And the uncertainty that we are currently seeing in the market is definitely contributing to the situation at the moment.
Perhaps I could add here, Stephen. I think the other factor that drove inflation structurally lower compared to the 1980s is globalization. So essentially, Chinese workers subsidized the rest of the world in terms of low wages. You saw a lot of manufacturing shifted from the US to China because of companies taking advantage of those low wages. Now, what we have seen since 2016 with Trump's trade policy, we have seen a lot of inshoring into the US. The pandemic also came. There's a lot of that inshoring that is taking place, where manufacturing is going to be regionalized instead of taking place between continents, as a way to reduce those risks that we saw during the pandemic, where you can't get important supply of components simply because they're produced in other countries. That is now going to be inflationary, and perhaps no longer will Chinese workers going to subsidize other regions in terms of low wages, because even their own wages are rising. Now we are going to go into a different regime in terms of inflation, where we are likely to see higher inflation, at least over the medium term, because of this deglobalization world that is taking place.
There's so much to it. I mean, Isaah, at the same time, if we have high inflation for a long period of time here and around the world, in the end, poor people simply can't afford food, and that's already happening here. I mean, that's going to lead to social discord.
Absolutely. I think food is now being weaponized. If you look at the dynamics that are taking place in Ukraine, but also even at the G7 level, we have had that, there was a push to say, let Africa manufacture its own fertilizers to make sure that they can, have lower costs for a very important component into the food production process. Yet Europe is taking a stance that it's going to be, environmentally unfriendly. You can't do it. While at the same time, we can't get supplies from Ukraine and Russia because of the war that is taking place. And that is the bind that Africa is going to be exposed to, but I think there is a greater move to say political leaders need to be able to establish ways to manufacture fertilizers in the African continent to cushion ourselves from the rest of the world. I mean, it's very surprising for a continent that has the largest amount of arable land to be having food insecurity. It's something that should not be happening.
The Chief Economist at Alexforbes, Isaah Mhlanga, thank you very much indeed. Lullu Krugel, Chief Economist at PwC, I really appreciate the time.